Welcome back to your 5-minute real estate update. Okay everyone, it has finally happened. After months of suspense, speculation, and press announcements, Fed met on March 16th and finally raised the federal fund rate by 0.25%. The direct result? The market responded with a huge increase in rates across the board, and the interest rate for 30-year mortgage is now approaching 5%. So how does that impact the Seattle real estate market? Let's take a look. The median price home in King County currently costs around $935,000. And compared to a year ago, this is roughly an increase of 13.5%. For the properties that were sold, they were on the market for 5 days on average before accepting an offer. From my personal experience, it is common practice for sellers in our market to have an offer review date, which means that they would wait for typically 3 to 7 days from the day they list their properties to the time they review and accept an offer. Therefore, days on market would have been even shorter if sellers were to accept offers as they come in. For the properties that were sold in March, they were closing at right around 111.5% of the asking price, which means sellers were getting on average 11.5% over what they were originally asking for. In March, we had 1,013 homes available for sale in King County, and compared to the same time last year, we had a decrease in inventory by 7.6%, and that's not good news for the buyers. When we compare that number in relation to how many homes that were closing, we had roughly 0.4 months of supply. As a balanced market is between 4 to 6 months, we're definitely still in a very strong seller's market. As mentioned in my previous video, despite of the recent spike in interest rate, buyers who need to buy are in a feeding frenzy because they want to be able to make a purchase before the interest rate goes even higher. According to Mortgage News Daily, back in August of 2021, the interest rates were a little below 3%. So we're talking about a huge increase of 2% from 3% to 5% over merely 9 months. If we were to take the median price home in King County, which is at $935,000, even with a 10% down payment, we're talking about a monthly payment of $3,500 compared to $4,500, which is almost $1,000 difference in monthly payments alone. So the biggest question of the day is that, are we in a housing bubble? And is the rising interest rate the needle that pops it? With the interest rate surging faster than expected, Redfin, Zillow, and CoreLogic have all revised their 2022 forecast. So let's take a look together because I think you may be surprised by their new predictions. For Redfin, they say they are expecting the home prices to increase by 7% by the end of 2022. Previously, Redfin only forecasted the home price growth to be about 3%. Essentially, Redfin had more than double on their expected price appreciation despite of what's going on. Now for Zillow, they expect annual home value growth to continue to accelerate through the spring, peaking at 22% in May, before gradually slowing to about 17.8% by February of 2023. As you might recall from my previous video, Zillow predicted a 16.4% price increase by the end of 2022. So once again, they are even more bullish about the market. So finally, for CoreLogic, they predict the home prices will increase on a year-over-year basis by 3.8% from January 2022 to January 2023. They previously called for 3.5%. So they had also increased their projection on home appreciation. So the question now becomes that with the interest rate rising, why is everyone forecasting on an even larger increase on home prices? For Redfin, they increased their forecast from 3% to 7%, and for Zillow, they changed their projection from 16.4% to 17.8%. And for CoreLogic, they changed it from 3.5 to 3.8%, which seems counterintuitive. And this is my personal take on answering that question. I believe that interest rate is definitely a huge factor, and higher interest rate will definitely dampen the demand for housing. However, there are also more factors at play that impact the housing prices. For example, local employment, the economy, stock market, inflation, you name it. For us to really see home prices to go a different direction, I think the bottom line is that supply and demand has to balance out first. We still have quite a ways to go until we reach a more balanced market of 4 to 6 months supply. New construction has slowed down significantly with labor shortage and supply chain delays. Also, since 2008, we have a shift in our demographics in the US where people are staying longer and longer in their homes. Right now, the average home ownership duration is 10 to 13 years compared to 5 to 7 years previously. Finally, investors are becoming more and more active in the residential marketplace. Right now, about 33% of the homes that were purchased in the United States is purchased by investor. And that is 5% higher in shares over the past decade. So in the coming months, I will be monitoring the new housing supply in the pipeline very closely, and I will share any updates with you in the future videos. Please subscribe if you haven't done so already, and I'll see you in the next video. Thank you.